The goods and services tax is a broad-based consumption tax and it applies to the majority of sales in Australia. Set at a rate of 10%, there is a system of credits to ensure that the tax only applies to the value added during the sales process. This video focuses on GST and how it affects double entry accounting. It includes some taxation ideas, and you will learn more about those specific legal details of GST at a later stage. To charge GST or claim input credits, a business must first be GST registered with the ATO. Organisations must register if they have an aggregate turnover greater than $75,000 or $150,000 if they are a not-for-profit. Organisations with turnover less than this limit can elect to register if they wish. And taxi drivers must register irrespective of their turnover. Furthermore, in order to register, you must be carrying on an enterprise, which expressly excludes consumers and hobbyists from registration. We'll come back to this issue shortly. The GST legislation uses the term supplies rather than the word sales. GST only applies to taxable supplies, and this is mostly on things such as non-essential goods and services. However, it is important to be aware that there are a number of exceptions where GST is not charged. These are known as input tax supplies and GST-free supplies. They can include such things such as wages, residential rents, interest income and interest expense, dividends, exports, registered education, fresh food and essential products, fines, taxes, and many, many more. This list is far from exclusive. Which items are in and which items are out are determined by the government in a long and sometimes arbitrary published list. This can have some unusual effects. For example, fruit juice is GST free, but carbonated fruit-based drink, well, that will attract GST. And as a practicing accountant, you will simply need to be aware of the GST effects in your industry. The business activity statement. In the same way that you report earnings for income tax by filling out an annual income tax return, enterprises who are registered for GST will need to fill out a separate form called the Business Activity Statement, commonly known as a BAS. The frequency of a BAS lodgement will depend on the size of the business, but some of the options are annually, quarterly, and monthly. Quarterly registration is the default option, and it is by far the most common in Australia. Annual lodgement is only for the very smallest of businesses who are not required to be registered for GST and choose not to pay their GST by instalments. This is an opt-in system and it's designed to reduce the compliance load on small business owners. Monthly reporting is reserved for larger businesses which have a turnover of $20 million or more. How it works. Let's have a look at a worked example. When a business makes a creditable acquisition, that is, a purchase of a good or service, they will pay the price plus GST. This is then claimed back as an input tax credit from the ATO, being 1/11 of the final GST inclusive price paid. Conversely, every sale must charge GST collected, which is recorded as a debt because you now owe that cash to the ATO. At the end of the BAS reporting cycle, the business will net off the GST against the input tax credits claimed, and it will remit the remainder. If there are more credits than there are GST charged, then the ATO will issue a GST refund. At this point, the two GST ledgers should both be zeroed. So to reiterate, if there was a purchase or outgoing, then you will need to increment the GST paid ledger, which is an asset. If there was a sale or incoming where you issued a tax invoice, then you will need to journal GST collected, which is a liability. Both ledgers are held on the current account and they're cleared every BAS cycle, which is usually every quarter or month end. Let's go through an example. Fiona the photographer runs photography as a sole trader. Fiona makes a purchase of $33, GST inclusive, of internet advertising from an Australian GST registered business. Fiona records the $30 of expenses plus $3 of GST paid, which is an asset, and she claims this as an input credit back from the ATO later on. This advertising leads to a very small job, which she bills the client for $66. $60 of which is revenue, $6 is GST collected. That would be a liability that you now owe to the ATO. Side note. While GST is 10% of the sale, you should realise that it's 1/11 of the final amount paid, that is the price including GST. At the end of the BAS period, she will net the two accounts off and remit $3 to the ATO. That $3 check is sent to the ATO with the BAS that shows exactly how she calculated that number. Note that the value added over the sale process is $30 and the GST is 10% of that value add, being $3. This process is repeated with many businesses along the value chain. You will see that along each step, GST is owed and credited back to the ATO. Really, it's only the final consumer who ends up bearing the tax, since they are unable to register for GST and thus they cannot claim the input credits back from their purchases. This system of input tax credits means that GST is designed to be business neutral, meaning it does not affect profitability. This split between the economic and legal incidence of the tax means that consumers are the ones who end up paying the value of the tax, but businesses are the ones responsible for sending the actual check to the tax office. And this effectively means that Australian businesses are an important part of the Australian tax collection regime. This is why business-to-business transactions quite often quote prices plus GST, but business-to-consumer transactions are almost always including GST in the final price. Journal entries for accrual transactions. Now, we've seen journal entries for simple cash transactions. Let's now have a look at GST for accrual accounting. But firstly, a quick side note on accounting for GST under cash and accrual basis. Small businesses are allowed to account for GST on a cash basis. Who's the small businesses? Any business with an aggregated turnover of less than $2 million will qualify for the SBE Small Business Entity Concessional Tax Rules. You should also be aware that tax rules and financial accounting rules can sometimes have significant differences. Concepts that apply to financial accounting don't always 100% carry across into tax accounting. Although it's a little weird, it is possible for small business entities to be reporting their GST on a cash basis, while at the same time running their financial accounts on an accrual basis. And this gets a little bit confusing. So in this example, I'm going to treat the business as using an accrual accounting method for both tax and financial accounting. Just keep it simple. Generally, GST will be recognised wherever a tax invoice has been issued. That is, we issue a tax invoice for a sale, and when we make a purchase, we receive a tax invoice from the vendor. Now, this might seem a little bit obvious, but we need to clarify some words here that are commonly confused by everyday consumers. An invoice is a document that's issued by the vendor, and that is, it's evidence of a sale. A tax invoice is an invoice that meets Australian taxation requirements as evidence for GST purposes. So it's going to show the ABN, the amount of GST paid, and the words tax invoice prominently featured on the top. Details like that. You can mostly just use the terms invoice and tax invoice interchangeably, provided you're only talking about Australian businesses that are registered for GST. Now, a receipt is a document issued by the business collecting cash. A receipt is not the same as a tax invoice. Now, most consumers commonly confuse the two words because consumers will pay at the point of sale for pretty much everything they buy. And in this case, the business just issues one document called a tax invoice, and it includes payment information down the bottom. The majority of business-to-business transactions, however, are conducted on credit. So if you're an accountant, you need to separate these two events in your mind. In the rest of this course, we're going to use accrual. So this means that you should always assume that GST is recognised on the accrual basis. GST will apply to the economic event rather than the cash settlement event. A credit sale will look something like this, with GST being charged at the point of sale. Debit accounts receivable, which is an asset, credit sale, which is revenue, credit GST collected, which is a liability. And when you collect the cash, debit bank, credit accounts receivable. Note, there is no GST entry when the cash is collected in the second journal entry. So conversely, any expense which was purchased on credit will look something like this. Again, we'll go with the advertising example. Debit advertising expense, debit GST paid, and credit accounts payable, which is a liability. Later on when we pay, debit accounts payable, which will push that liability to zero, credit bank, which will push the asset down. Finally, remember that GST is a transactional-based tax. This means that if there are events which are recorded purely by journal entries, then there will be no GST applied. A good example of this is depreciation. This video was a quick overview of GST, but there's so much more to dig into. Today we focused on the mechanics of how to record GST in common journal entries, and an easy way to remember when to include GST is to simply think about when that tax invoice was issued. GST is not recorded with the cash receipt or cash payment. My name's Philip Wong. Thanks very much for watching. Happy studies, guys.